Good morning, everybody. It is just about 10 o'clock on Tuesday, October 4th. It's a rainy day here in Bucks County, Pennsylvania, but I'll take a little bit of rain compared to what our friends in Florida and other areas have experienced. My gosh, I keep looking at the damage. Some of my favorite places in the world, Key West and Captiva, Florida, and Captiva just got it really bad, unfortunately. If you've ever been to Captiva, or if you've never been to Captiva, it's a beautiful little island right off of the Fort Myers area, and both Fort Myers Beach and Captiva and Sanibel. Sanibel is the kind of the stop in between Fort Myers and Captiva. It's part of the island there. Just got annihilated, and it's really sad. So I'll take a little bit of rain over what they're dealing with. Okay, let's get started. It's 10 o'clock. Good to see everyone. So I want to just remind everybody that, of course, you are being recorded. There is no live communication coming back to us. There is a Q&A button, and the chat feature should work too now. So if you want to throw up a chat, let's actually try that. I'm looking over at my screen. I'm just going to say hello to everybody. Let's see if everybody can see, but you might not be able to respond. So hello, I'm just going to say hello. And if you can respond, go ahead and respond. We'll just have a little bit of fun here on a Tuesday morning. Zoom's a little finicky sometimes, and they're set for different regulatory environments. So you may not, in fact, be able to respond. But if you have a question, hi, Don. If you have a question, you can fill in that Q&A section, right? Yeah, I see somebody just did that. Steve said chat's disabled. Okay, well, thank you, Steve, for that. That's helpful. Everybody's telling me chat is disabled. So that's really helpful. Let's just stay in Q&A and make things a little easier. That might still be disabled from previous regulatory requirements when I set this up. I started doing these webinars March of 2020 at the beginning of the pandemic. But thank you, everybody, for the feedback, and good to see some familiar faces. Okay, our list grows every single week, and now I've lost my little handle there. Our list grows every single week, so all you folks to keep coming back week after week. It's always nice to see you. Okay, so we talked about the recording. We talked about the chat and the Q&A feature. If you're joining us on YouTube, please hit the subscribe, like, and notification button so you get your updates, and we get more and more subscribes and people watching our YouTube videos every week. So that's kind of neat too. We try to keep it up to date and timely for you. So I've talked a lot about the new website that's being developed. So I'm hoping that's done by the end of the year. These things do take quite a bit of time. So just be patient with me, but I think it's going to be really great, especially the Attleboro U portion of it, where you're going to be able to go on and find a program. Like today, for instance, we're going to talk about, in our financial planning section, we're going to talk about indices or indexes, however you want to say it. I'm not sure which one's proper, but I use them both. Like the S&P 500 we often talk about, or the Dow Jones Industrial Average. So we're going to do a little talk about that today, so you're aware of what the heck we're talking about. Well, you're going to be able to do a course in the new website and go through and learn about for example, the indices and what they mean, and then you'll be able to finish that course and kind of have that in your course log. So that should be really, really exciting and fun. So let's hope that all works well. Okay, so do me a favor, everyone, just raise your hand if you could see me and hear me okay. I know a couple people already chatted. Great. All right. We do have a special webinar coming up in October. We haven't had one of these for a few months now because we're so busy with classes. We just wound down a series of Changing World of Retirement Planning classes just last Tuesday. So we just finished that class. It's the last class for the year. Oh, hey, and if you didn't see it, I'm going to send out an email with a video. David McKnight did a special TV special here in the Philadelphia region Saturday night on NBC, our local NBC channel. And some of you folks might have been joining us from that broadcast, but it's always good to see Dave, and we set that up together. So it's always a good partnership with David McKnight. Great information. All right, so I told you today we're going in our financial planning, investment fundamentals. We're going to be talking about indices, and let's talk a little bit about headlines. So this headline really grabbed my attention. Kim Kardashian is ordered to pay $1.3 million to the SEC for crypto touting. So Kim Kardashian will pay $1.26 million to settle a Securities and Exchange Commission allegations that she broke U.S. rules by touting a crypto token without disclosing she was paid for the promotion. So it seems as though Ms. Kardashian got $250,000 to promote a crypto asset offered by a company called Ethereum Max. Yes, Ethereum Max. And she didn't disclose it. So now she's got to pay $1.3 million, which is a lot of money to us. I hope it's a lot of money to her because maybe she won't do that again. And maybe other celebrities won't do it as well. Although there's been a few, particularly with crypto over the past couple of years. There's a lot of talk about real estate right now. And I'm looking at a headline that says, let's see, how the approach for real estate is rapidly changing the economy. What is the future of real estate? Is real estate in a decline? Have we hit the bubble? So a lot of discussion about real estate right now, and let's just keep our eye on that. There may be some good investment opportunities in real estate. That is not a recommendation, of course, just a discussion item. You folks who know me know that I've been a real estate investor for a long time, and it's certainly an asset class that I believe in. Medicare, we got notice that Medicare Part B premiums, the IRMA surcharges. So we talk a lot about IRMA, both in our financial planning process and you've heard me talk about it on these webinars. IRMA is the income-related monthly adjustment amounts that are added on to your Medicare premiums after you start collecting Medicare. So they're typically deducted right out of your Social Security, but they can be pretty steep. So you can find the existing IRMA. I'm going to share my screen, I guess, over here. Let me close down some things just so you don't see. Uh-oh, I lost my monitor. This is the second time this morning I lost one of my monitors. So, okay, it's back. Let's hope that doesn't happen again. I'm going to share my screen really quickly, and I'll show you where you can find the IRMA worksheet on our website. So here's our existing website, soon to be replaced by our new website. And if you go to the Ed Slott corner, so here is the landing page, our home page. If you go to the slot corner, and I'll be with Ed in a couple of weeks. I'm excited about that. I'll be out in Las Vegas with Ed. Maybe we'll do a mini broadcast from there. Not a promise. But if you scroll down here, these are Ed's charts. So you'll see here, copyright Ed Slott and Company. So I put it on that portion of the webpage, give him full credit. And if you scroll down, you'll see the 2022 Medicare income planning. So this talks about IRMA, income-related monthly adjustment amounts, income-related monthly adjustment amount. And it shows what the filing charges are or what the charges are for filing single and married filing joint. And where it says $91,000 or less, or $182,000 or less, that is based on your modified adjusted gross income. And this is not just an increased kind of scale. This is like your tax rate is, your marginal tax rate, where you have an effective tax rate where you slowly increase. This is a cliff. So once your modified adjusted gross income goes over $182,000 to $228,000, you pay this extra $68 for 2022. So your total Part B premium for 2022 would be $238.10. Surcharges for Part D, and then the total surcharge for Part B and D would be $80.40. And then you can see it increases dramatically. And this is per person. So if you have a married couple who is, I lost my monitor over there again, and that's the third time. And I have a lot of my information for today sitting there. So after we talk about this, I'm going to move things over to my right monitor. So bear with me. So that's a look at IRMA. And again, you can download this chart by clicking on here and have it. You can just reference it on the website. That's fine too. All right, so stand by with me. I'm afraid I'm gonna permanently lose this monitor, so I'm gonna move it. So we talked about Kim Kardashian, we talked about Medicare, we talked about real estate. As far as headlines go, my increasing headline. Let me tell you why Medicare benefits may be declining. So they write the decreases reflect a partial rollback of the big increases in 2022. We did see a big jump in 22, following a big cut in the cost of a new Alzheimer's drug. So we are expecting, for example, individuals enrolled in Medicare Part B, which covers doctor visits and outpatient services, will pay a monthly premium of $164.90 in 2023, which is down $5.20 from $170.10 in 2022. So it's not just a reduction of the increase; it's actually a decrease, which is good. There was a 15% increase last year, so that's good to hear. In a time when everything else is increasing, you know, I ran to the store over the weekend to pick up a couple steaks, and I couldn't do it. Just the steaks for $26 a pound. I couldn't do it. It's just horrible. Okay, so now we're going to jump into the slot updates here. I see a question. Keith asks, what about the UN warning that the world is on the brink of recession and asking U.S. Central Bank to stop raising interest rates? So I think Keith is implying that it's a headline we should be talking about. Listen, Keith, I believe, if you've been following that, we've really, when we're looking back, we've been in a recession since the beginning of the pandemic. If we're following the norm as far as recession, what tells us we're in a recession, right? The recession trigger points, or the recession. I can't think of the word off the top of my head, but the key points of a recession. So, and it's not just us. It of course is a global issue. It was a global pandemic. It's a global recession. We're all really in this together. The U.S. can't stop raising interest rates. Maybe they could decrease the velocity that they're raising them now, but we've got to help stave off this issue of inflation, which is, you know, having a large effect on everybody, and mostly the lower income individuals, right, who all have to buy gas and food, and no matter what your earnings are, we all have to fund things. So so Keith, it's a big problem. You know, if you want to send me an email and I'll dig through some headlines for next week, I'm happy to talk about it more in more detail. But good question and good topic to bring up. All right, where the heck was I? Okay, so I'm going to share my screen here now for the slot reports, or the slot updates. So let's go through these together. There's a lot of information, and Kathy made a good suggestion many months ago that we read these together. I appreciate that. Kathy's on the call with us today. So Andy writes this week that updates are needed. Top 5 IRA items to consider. And he writes right here, we are constantly bombarded with requests to update our information. Passwords need updating, software update for your mobile device. Please update your email so marketing team can continue to fill your inbox with spam. He writes, it is never ending. Most of these updates requests are trash and automatic delete. However, some updates are vitally important and demand our attention. Regarding retirement accounts and IRAs, here's a countdown of 5 critical items that should be considered, reviewed, and updated immediately. So the first is online 72T calculator. So this is something that a lot of folks aren't aware of or don't use, and it's a way that you can draw funds out of an IRA prior to 59.5 without that extra 10% penalty. It is complex, but not something we talk about a lot, but I'll run through it with you. It is not just individuals that need to do some updating. Custodians and webmasters must as well. Historically, when calculating a 72T payment schedule, a reasonable interest rate was required for the amortization or annuity factor methods. The rate was determined as any interest rate that is not more than 120% of the federal midterm rate for either of the 2 months immediately preceding the month in which the distributions begin. Another example of some complex language from the IRS. With IRS Notice 2022-6, that rate can be bumped to 5%. If 120% of the federal midterm rate is considered too low, many online 72T calculators have yet to update for Notice 2022-6 and do not allow the user to manually override the pre-filled interest rate. Updates are needed. So not a lot of folks, well, not a lot of folks certainly that I see are using 72T calculations. Again, that's if you're below 59.5 and for some reason you want to take your money out of your IRA. David McKnight talks about this in his presentation, the Power Zero presentation, and in his book as a way to, if you're under 59.5, to take funds out of an IRA and convert it to a Roth IRA. So it can be a really good strategy for that. But this is a really good example of how just going to a website, that isn't kind of checked for accuracy and doing calculations on that website can be dangerous. Number 4, life expectancy factors. The IRS issued new life expectancy tables effective in 2022. Anyone subject to required minimum distributions is required to switch to these tables for this year. That's really important. The updated tables are also on that Ed Slott page. If you scroll, I think they're all the way at the bottom or very close to the bottom. The required minimum distribution table is there for you to download. The result for both, I'm right here. The result for both lifetime and inherited IRAs will be slightly smaller RMDs. While failure to switch would not result in anything illegal, it would leave an account owner on an antiquated payout schedule and result in distributions that are slightly larger than necessary. Custodians must also update their software and online RMD calculators to reflect the new tables. Number 3, this is a big one, RMDs during the 10-year rule. Under the Secure Act, most beneficiaries will be subject to the 10-year payout rule. Remember, the death of the stretch IRA came with the Secure Act. When this pay period was first introduced, industry consensus was there were no annual RMDs for years 1 through 9. However, the IRS proposed regulations issued last February apply a strict interpretation of the 10-year rule. For anyone who inherited an account from a person who died on or after the required beginning date, RMDs apply in years 1 through 9. Beneficiary payout schedules from inherited IRAs should be updated to include those RMDs. This happens all the time. We had one of the folks who join us on a regular basis contacted me maybe a week or two ago and said, my husband doesn't have to take RMD. We're under the impression that my husband inherited an IRA. We're under the impression that he does not have to take RMDs. And the IRA had been a year or two old at this point since they inherited it. We're under the impression that he does not have to take any RMDs and can distribute it all after the the end of the 10th year. And in fact, she was mistaken. RMDs had to be taken, and she's got to take it certainly for this year. And it's yet to be seen what's going to happen for missed RMDs from last year, because the IRS told us one thing and then shifted gears and told us another. And they did, in fact, tell us the other, where Andy writes in here that it was an interpretation, and we thought we saw it this way, but in fact, the IRS came back and clarified and said, no, you don't have to take RMDs until at all during that 10-year period. And then, so they reversed themselves and then reversed themselves again. And we are stuck now. We don't have permanent rules, regulations or rules yet, but the temporary rules say, the proposed regulations say that you have to take distributions during that 10-year period. So trust, number 2, if you name the trust as your IRA beneficiary, and if the trust was drafted prior to the Secure Act, it definitely must be reviewed and potentially updated or scrapped altogether. The Secure Act turned IRA beneficiary planning on its ear, and trusts as IRA beneficiaries are far less effective than they once were. As such, trusts created prior to the Secure Act must be updated. Failure to do so could completely undercut the original intent of the trust. So that goes back to reviewing your plan every single year and updating it based on the rules, regulations, and laws that we have today, and of course, the needs that you have today. Beneficiary form. You've all heard me talk many, many times about how important it is to review and update these beneficiary forms. Even if you think you know that they're all correct, check, check, check every single year. Take a look at it. Get that printout. Make sure you see it online, however you want to do it, but don't assume. Far and away, the most important item to review for possible updates are beneficiary forms. Time and time again, I am right here. Time and time again, we see cases where retirement funds, dollars that took a lifetime to accrue, get paid to an unintended beneficiary, get gobbled up by attorneys as people fight over the proceeds. Beneficiary forms should be reviewed at least annually and more frequently as life events occurred. Marriage, divorce, new child, all are legitimate reasons to review and potentially update your beneficiary forms. Retirement tax rules are dynamic. In addition to the items above, be sure to update your general knowledge to stay current with important things in life. Attend this weekly webinar. Every week we run through and we have these updates from the Slott Group, and it keeps you on your toes. You don't have to be experts. I don't want you to be experts in this. That takes a lot of time, devotion, and you want to enjoy your life, your retirement, wherever you are. But you want these things to trigger something, like the woman who reached out to me and said, I don't think that we have to take RMDs, but can you please give me your thought? And if she would have gone another 6 months with thinking that she was correct, she would have missed another RMD, another potential 50% penalty on that amount that should have been taken, which can be significant. So this is from Sarah Brenner. IRS regulation, QCDs. QCDs are a hot discussion right now. A lot of folks are considering and doing QCDs, qualified charitable distributions. So Sarah talks about that a bit in this report mailbag. So these are questions that are written in, and then the Slott team responds back. So the question is, when will the IRS release final regulations for RMDs on beneficiary IRAs? And that's what we were just talking about. They released the proposed regulations that reversed their original position that require minimum distributions during that 10-year period if the person who you inherited the IRA from had already passed the required beginning date. So basically, if they had attained the age of 72 and were past April 1st of the year following. So the answer is, hi, Kim. That's a great question. We've been fielding many inquiries about when the final regulations will be released by the IRS. The proposed regulations were released back in February, and the hearing was held in Washington a few months later as required by law. We are still waiting for final regulations, and no one really can say for sure when they will arrive. At the Slott Report, we carefully monitor any news coming out of the IRS, and we will keep you up to date on developments of final regulations. Another great example of why you should tune in here every week, and why I just love these folks at the Slott Group. They just keep us current, up to date, and we have a better chance of never missing anything. Next question. Will RMD distributions paid to charitable organizations as a QCD, qualified charitable distribution, be counted in income calculations for the purposes of IRMA? Again, I reviewed it earlier. IRMA is the income-related monthly adjustment amount that is calculated based on your modified adjusted gross income that determines how much more, if any, you're paying for your Medicare benefits. So this is really important. The question is, well, if I do these QCDs, will that income be calculated? So if I do $100,000, for example, as a qualified charitable distribution, take it out of my IRA, send it right to the qualified charity, don't put it in your bank account, send it right to the qualified charity. Does it count as income? Well, what do you think? All right, you might have read ahead, but RMD distributions that are not QCDs are counted, this person says. Of course they're counted. So the answer is, hi, Bill. One of the biggest benefits of doing a qualified charitable distribution, or QCD, is that the funds go directly to the charity, are not included in adjusted gross income for the purposes of calculating IRMA surcharges for Medicare. You are correct that RMDs that are paid to the individual would be included. This can be avoided by using a QCD to take your RMD, as long as you meet the requirements. Right? So you have to be over 70 and a half, not 72. You have to be over 70 and a half. And it's not in the year that you turn 70 and a half. The IRS requires you to pass that milestone. So if if you're 70 on January 1st, you would be 70 and a half after, what would that be? June 1st, July 1st. See, that's where you can get messed up. You've got to cross that bridge to 70 and a half before you can do that QCD. So really good, good stuff there. All right, I'm going to stop sharing my screen, and I'm going to talk to you about investments. So I'm actually going to share with you again. I like sharing this Invesco because we're going to talk about this is the report we get from Invesco every week, hopefully, because I love the way they put these numbers together. But these are so what I'm going to talk about today are indices. So this is what I'm often referring to, and I just want to remind you, this goes back to investment fundamentals. We want to talk about what are these indices and what's it mean. So we're looking at end of September, right? So the quarter ended last week, and the week was down. So we had a big day on Friday. We had another big day yesterday. It's positive a bit today. So hopefully it stays that way. When I say it, I was just looking at the Dow Jones Industrial Average. So it still ended the week down just about 3%, negative 2.92. You can see here the S&P 500 was negative 2.89. And you'll see in a few minutes why those are often very close, including the NASDAQ is down negative 2.68. Year-to-date numbers are negative 19.72, negative 23.88, negative 31.99. And you can see that actually all these indices were down for the week and certainly down for the year. And this 1 year means this time last year compared to this time this year. So September 30 last year compared to September 30 this year. And then you can see the fixed income. So these are equities or stocks. Equities equals stocks. Then we have fixed income, that equals bonds. So that's the same as bond. And the most common investment area that people invest in is this Barclays Aggregate Bond Index. So the maturity in that tends to be around 5 to 9 years. And you can see that was down last week as well, about 1%, 0.99%, and over 14% for the year. And as you've heard me say over and over again, this is what are really galling people when they say, well, wait a minute, my target date funds automatically move me to bonds because they're less risky. And yeah, in this example, they're showing that they have lost less than the overall stock markets, but people still aren't expecting a 15% drop in their bonds, in their air quote, if you're listening to me instead of watching, air quote, safe investments. So you've been hearing me over and over again talking about the risk of bonds in an interest rate environment. I've been talking about it for, it feels like a decade now, but here we are. And in the middle here, you can see interest rates. So I'm in the middle. So you'll see where the interest rates closed at the end of the month and the end of the quarter. So the Fed funds target rate was 3.25. A year ago, it was 0.25%. So that's all that upward movement that we're hearing about over and over again in the news about the Fed tightening and increasing interest rates. So every time they increase those interest rates, you know, that's what we're seeing. The 10-year Treasury is at 3.83%. Prior week was 3.68, so you can see it climbing. And then a year ago, there was at 1.49. Now, last week we talked about bonds, and I talked about this is an important point here. The 10-year Treasury is 3.83. The 2-year Treasury, and if that means that you're buying a bond that matures in 10 years from the U.S. government for a 10-year Treasury. The 2-year Treasury, you're buying a bond that matures in 2 years. So typically you get more interest back to you for holding that bond for a longer period of time. In this case, you get 3.83% for holding that bond. That's annually. So for holding that bond for 10 years, taking more risk over 10 years. But here you're getting 4.28% for holding a 2-year bond. It matures in 2 years. So which would you rather have? Well, most people, of course, would want that higher interest for the shorter period of time, less risk. That's what we call an inverted yield curve. And that is also a marker for recession. Okay, let me stop that share. So that's what we're looking at for the general markets. Let's talk a little bit about some of our analyst reports. And I believe I only have one, and then we're going to get right into our financial planning topic. So this week is BlackRock. The Great Moderation is over, they call it. The Great Moderation, they get a little technical here. I'll try to clean it up best I can, but the Great Moderation, a period of steady growth and inflation, is over in our view, BlackRock says. Instead, we are in a new regime of heightened macro volatility driven by production constraints due to post-COVID supply distributions and labor shortages in the near term, and structural forces such as bumpy net zero transition. And so remember, the net zero is really people going to a net zero carbon footprint, so to speak. So, you know, net zero emissions. and a rewiring of global supply chains amid geopolitical tensions over a longer horizon. So this goes back to what I'm sorry, I don't remember who asked that question, but really this is a global issue. How about we'll talk about a global recession? What are the thoughts out there? And BlackRock is saying they're all over it. This warrants higher risk premium. So a risk premium is the amount of money return that an investor is willing it wants to get for the amount of risk that's being taken. So just like I explained to you, typically with the 10-year bond, because you're willing to take more risk, hold that money for a longer period of time, usually the 10-year bond pays a higher interest rate, but now it's upside down. So BlackRock's saying all of these things warrant higher risk premiums to be able to hold stock positions in particular they're talking about. The compensation investors want for holding assets, that's a risk premium for bonds and equities, stocks, for bonds and stocks. We ultimately expect central banks to live with inflation, but only after stalling growth. The result, persistent inflation amid sharp and short swings in economic activity. So they expect they go on to talk about, and they had some good charting talks about the volatility they expect in economic activity instead of just so big spikes, big drops. For the last decade and a half, it's been pretty steady as interest rates have been also. We've had little bits of pops ups and downs. Certainly inflation has been low and interest rates have been low over time. Remember, over the last decade and a half, every time the Fed tried to raise interest rates, the market and the economy would really come crashing down, and then they backed off. They're not doing that this time. The new regime is a riskier one than the Great Moderation, in our view. That means investors should demand more compensation for taking the same levels of risk, higher risk premium. So with that, they're talked about this before, but they're upgrading debt to overweight. So this is their tactical positioning. And again, this is just one analyst report. It's not a recommendation, but they're saying in their portfolios, they're going to overweight bonds over stocks. We see nominal yields in 5 years time significantly higher than current levels. This gets really technical. So let's just leave it with they are liking bonds more than stocks. That doesn't mean they're not holding stocks in their portfolios, but they're liking both investment grade and high yield bonds in developed markets. So more stable economies throughout the world. All right, let me just see if there's any questions here before I move on. All right, seeing none, we're going to jump into our financial planning topic. All right, so now we're going to talk about indices or an index. We talked just now about the S&P 500, the Dow Jones Industrial Average. So I like to, as you know, I like to go as much as possible and grab information for you from websites that you can visit. So I went right to Investopedia. Actually, I Googled it because I always want to see what's best, but I really like Investopedia. It is for general descriptions or definitions of different market tools or activity, things like that. So Investopedia says, what is an index? An index is a method to track the performance of a group of assets in a standardized way. Indexes typically measure the performance of a basket of securities intended to replicate a certain area of the market. So let's look at the Dow Jones Industrial Average first. So I'm going to pull these up. So I'm going to actually put this down like I typically do. So you may see the top of my head and I'll be looking down, but I'd like to be able to draw on these. So let's talk about the Dow Jones Industrial Average. So what is the Dow Jones Industrial Average? So the Dow Jones Industrial Average is 30 individual companies chosen for stability of growth and earnings. I'm reading a definition. This established in 1896 by Charles Dow and Edward Jones at just 12 companies. This has changed 51 times since 1928. The Dow components are chosen by S&P Dow Jones indices. There are no specific rules for inclusion. Generally speaking, components of the Dow should be large and respected companies. However, they aren't the 30 largest companies in the market, a common misconception. So you'll often hear me say when I refer to these indices, this is roughly the largest companies in the US, so this is 30 of of the most respected, should be large and respected companies in US, right? These are definitely United States industries, but of course, they can have effects globally. All right, I'm missing a, and let me share with you, this is a good site. There's a lot of ads on here, but I'm dragging this down. So this is Slick Charts. So this is really, really basic, but it's a good charting system. If you just want general information on really just stocks. I haven't found anything on here that has anything to do, excuse me, with bonds. But here's, for example, we're talking about the Dow Jones Industrial Average. So of course you see what the Dow is doing right now, and you can go into the Dow and you can look at annual returns. I'm over here on the right. Annual returns, performance, year-to-date return, dividend yield, index analyses, and this talks about the 1929 crash. But let's go in and look at the companies, and this is a free site, as you can see by all the different ads, and you can see that I've been looking for a rental car in Las Vegas when I'm out there, because that's what's popping up. So let's take a look at the different companies in the Dow Jones Industrial Average. And these are price weighted. So it's depending on the price of the company, the market price. And you can see how it works here. Here's the price of United Health Group. Now, of course, none of these, I have to disclose, none of these are any recommendations, especially if you're just joining us via YouTube for this topic. And again, if you are, just subscribe for me, hit the like button and your notification button. But any of these companies that I'm showing here, it's not a recommendation to buy, sell, or hold any of these companies. So United Health Group here, you can see that that has the largest price, and then it scales down. So this is price weighted. And then you have Goldman Sachs, Home Depot, Microsoft. I kind of want you to just take a snapshot of this in your mind. McDonald's, Amgen, Visa, Honeywell. So you'll see that even if you focus on the top 10, these probably aren't any surprises for you. Now, that's the Dow Jones Industrial Average. Now, we often hear about the S&P 500, and we'll get there in a moment. And you see that over here. So, and I told you that the returns for the Dow Jones and the S&P 500 aren't exactly the same, but they tend to track pretty closely. I mean, there's sometimes the S&P is higher or lower than the Dow, but you'll see why in a few minutes. The S&P 500 or the Standard & Poor's 500 index is a market capitalization weighted index of the 500 largest U.S. publicly traded companies. The index is widely regarded as the best gauge of large company U.S. stocks, whose components are weighted according to the total market value of their outstanding shares. So that's what capitalization means. S&P 500 is price weighted. Whomever has the highest price, they have the highest place. This market capitalization is based on the company's number of outstanding shares, the market value of their outstanding shares. So you'll see here, and if we go into the S&P, so this is the Dow. Let's go into the S&P 500. So here's where you'll see market capitalization: Apple, Microsoft, Amazon, Tesla, Alphabet, that's Google, Berkshire Hathaway, United Healthcare, United Group, right? So there's a repeat there, but you'll see that United is I don't know if it's the highest price in the S&P 500, it might be, but it comes down at number 8 here. Johnson & Johnson, Exxon, Meta, right? So that's Facebook now, JP Morgan. So you can see that there are some similarities there. They're weighted differently though. Now, one of the other ones that we talk about is the Russell 2000. So the Russell, and again, these are non-managed indices or indexes. So these exist out there, and we compare money managers to them. So if we talked about the S&P 500 being the best gauge of large company, large US companies. So if I hire a manager or a mutual fund to manage that portion of my money, I might compare them, being large company US stocks, equities again equals stocks. I might compare them to the S&P 500. And if the S&P 500 returned 10% and that money manager or mutual fund did 11%, then they have some value over just owning the S&P 500 as an exchange traded fund, which is something we talked about a few weeks ago. On the other side of it, if the S&P 500 fell, 20% in a year, and that money manager, mutual fund or individual money manager, only fell 15%, then of course that's an added value as well. So these are the things that we use these indices for, is to compare how people are doing when they're managing our clients' money. So they're referred to as benchmarks also. So you might use the S&P 500, which you just learned about, as a benchmark to your investments or how a manager is doing for your investments. So I hope that makes sense. Another one is the Russell 2000. So the term Russell 2000 index refers to a stock market index that measures the performance of 2,000 smaller companies that are included in the Russell 3000. I know that's a little confusing. Generally, the Russell 3000 is a broader market index that includes smaller companies and larger ones like the S&P 500 and the Dow. So again, the S&P 500 and the Dow tend to be much larger companies. Now we're getting into the Russell 2000, which is small and some mid-sized companies. The Russell 2000 is managed by the London's FTSE, or what we call FTSE Russell Group, and is widely regarded as the bellwether of the U.S. economy because of its focus on smaller companies that focus on the U.S. market. So they're saying that the smaller companies tend to drive the future of the U.S. markets. Many investors compare small company mutual funds against the index's movement, and we talked about that, as it's seen as a reflection of opportunities in that entire subsection of the market, the narrower indices. So let's look at, oh no, do we not have the Russell here? Okay, I can't show you the companies in the Russell 2000, but I can show you now the NASDAQ 100. So the other big one that we see, right, it's right here, NASDAQ 100. Is another big one. So the NASDAQ 100 index is a basket of the 100 largest, most actively traded U.S. companies listed on the NASDAQ stock exchange. So this doesn't represent all of the NASDAQ, just roughly the top 100. The index includes companies from various industries, except for the financial industry, like commercial and investment banks. These non-financial sectors include retail, biotech, industrial, technology, healthcare, and others. The index is uses a modified capitalization methodology. This modified method uses individual weights of included items according to their market capitalization. Weighting allows constraints to limit the influence of the largest companies and balance the index with all members. So it's kind of a blend. It's not really, but it's more of a blend between price weighting and just market capitalization. It's the idea of the NASDAQ was, let's give it a more fair weighting. So let's look at what's in the NASDAQ 100. And I hate all these ads. But NASDAQ 100 companies are, I did switch that. Let me go back to the S&P 500. And this is what I said, take a snapshot, a mental snapshot of what's in your head. And that's why you see some of these indices operate the same way. With the S&P 500, this is the S&P 500, right? Companies by weight: Apple, Microsoft, Amazon, Tesla, Google. Let's switch into NASDAQ. Apple, Microsoft, Amazon, Tesla, Google. So one of the things that we saw coming out of the pandemic was we really had 5 or 6 companies that were driving most of the market. And you're looking at them right there for the most part. There were some others too, but there were a small number of companies that were driving. So of course, when there is a market adjustment, it likely will fall pretty quickly. All right, lost my monitor again. Okay, so they are indices. So let me just recap there. So we talked about the NASDAQ 100, we talked about Russell 2000, we talked about the S&P 500 and the Dow Jones Industrial Average, and how these indices are made up, how they're weighted, and what they're used for. So they can be used to just purchase these broad markets. And we have these things called exchange traded funds now that you can purchase, that you can buy the entire S&P 500 with one transaction. Very, very simple. They can be efficient. They can be very, very cheap. You can probably buy the S&P 500 through Vanguard. Again, not a recommendation. And the fee on that would probably be somewhere around 0.03%. You've got to be careful when you're purchasing exchange traded funds to track an index, to make sure that they're accurately tracking that index, because there is a drift that we often see with ETFs. or exchange traded funds, the returns will be significantly high, below or above what the returns of the index are. All right, that's your financial planning topic for the week. I do see a question, so let me stop my share and adjust my tablet and see what the question is. All right. Most managers historically fell short of S&P 500 returns, Gerard writes. Yeah, Gerard's right. So unfortunately, most of the, I say this often, most of the investment managers, whether they're individual money managers or mutual funds, are either mediocre or stink. There's a very small percentage, and it's about 8% that can routinely beat their index. And that's why ETFs have become so popular, because people say, why am I paying anything for a money manager to underperform, much less 1% or more? You know, when I first started in the industry, the average fee was about 2.25%. So that's changed quite a bit, but good point, Gerard. All right, folks, that's it for today. I look forward to seeing you next week. Next week, we will have a webinar, but the following week, we will not, because I'll be in Las Vegas visiting my friend Ed Slott. Looking forward to seeing you all soon. And please answer the survey that follows this and email me with any questions you have. Have a great week. Take care.